Very good morning, friends. So I hope all of you are doing good, and I hope you watched the last class as well. We started off with financial instruments yesterday, and we started with the inputs on Ind AS 32 with you, wherein I created a three-step model with you, and I've almost given you exposure draft number 2 on how do we decide whether a given instrument issued by the company is a financial liability or is it an equity instrument. I'd also given you a total of 5 MCQs to try, and I think before I take the journey forward today, I'm just going to give you the answers for those MCQs, though I guess you would have been able to answer them there and then, but I think still, let me just share that with you, and I think give you the answers on that. Okay, so good morning, Rashmi. So let me, I think, begin the journey first of all with you. So I am coming to, first of all, the 5 questions which I gave you in MCQ yesterday before we take the journey forward. My first question which I gave you was that if there is an obligation by law, and I think I underlined the word as well, that if there is an obligation by law, it is a financial liability, and this is false. Because we identified in step number 1 that for an obligation to be within the parameters of this particular index, it should be a contractual obligation. Now, when I say it's by law, it is a statutory obligation, and that is not covered under this index. So the first one is supposed to be false because it's an obligation not by contract, but by law. The second question I gave is that if the mode of payment is cash, it is definitely a financial liability. So I was trying to test you that if the mode of payment is cash, is it 100% a financial liability? No. We said that the mode of payment might be cash, but you need to look into the fact that is there an unavoidable obligation to pay or not? So in a situation, if the mode of payment is supposed to be cash, you need to be proving that is it mandatory or is it discretionary in nature. So if you say that it is mandatory in nature, then it becomes a financial liability. But if you say it is discretionary, then it is not a financial liability. So the second statement is also false because we cannot say on 100% surety that it is definitely a financial liability. Then the third statement was that if the mode of payment is goods and services, does Index 32 is not applicable? I think I gave you in step number 2 that you can consider for the time being that mode of payment are exhaustive in nature. Either the mode of payment is cash or the mode of payment is that the company uses its own equity share as a currency note. So if there is a settlement mode by way of goods and services, it is not under the purview of the standard. Then I gave you that Index 37 would apply in that case. Like, for example, if there is a warranty obligation and the company would settle the obligation by way of providing goods and services, then the standard 32 is not applicable. So this statement is true. So the first 2 were false and the third is true. Then I gave the fourth one that if mode of payment is equity shares, we need to apply the fixed test. And I think that was my step number 3, where I very clearly gave you that if the mode of payment is equity shares, we need to go to the step number 3 and apply a fixed test in this case. So the fourth one is again true. So the first 2 were false, the second, third, and the fourth is supposed to be true. And finally, we've got another fifth one, that if the mode of payment is cash, we need to apply the unavoidable test. And I think that also makes sense, which I indirectly answered in the question number 2, that if the mode of payment is cash, we definitely need to see whether the payments are mandatory or whether they're discretionary in nature. So when I say that we need to apply the unavoidable test, that there is an unavoidable obligation to pay, that is also true. So the first 2 were false and the last 3 were supposed to be true in this case. Okay, I hope you got the correct answers on that. And I think I'm getting some answers coming, good answers from Nidhi, Rashmi, and all. Wonderful indeed. Okay, I think Rashmi, you said all thrive are true. Oh my God. I think I've finally given the answers on that. Okay, so I think with these inputs in hand, I think we can take the journey forward. So I think let's take a quick recap on what we learned yesterday. If you've got any questions coming in, do ask me, then I think I'll take the journey forward. So I hope you made a revision of the concept, what we covered up yesterday. So before that, I think let me just take a quick recap on things with you. I'll just share my screen as well. Just give me a second. Okay, let me just take a quick recap in terms of things with you. So I am coming back to my board, and I think let's take a quick recap in terms of what we learned in the yesterday's class. Well, I gave you a three-step model, and just to remind you in terms of the three-step model, the first focus in terms of the step number one. The first focus in terms of the step number one was looking at that the obligation is contractual in nature. So this was my exposure draft number two. And I said that you need to focus on two important inputs, that the obligation is contractual in nature. Now, when I say obligation, immediately what should come to the mind is that there are two components of the obligation. Your mind should immediately tell you that there is a principal component and there is an return component, which you need to analyze in this case. And maybe if the two modes of payments are different, or maybe if the mode of payment is common as well, you'll have to make a run through regarding the principal and the return component. So apply the three-step model for each component separately and take a call whether it's a financial liability or it's an equity. Secondly, when you focus on the word contractual, you need to understand that we are having three kinds of obligation. One is by virtue of law, which is not covered here. One is imposed, a self-imposed obligation, which is constructive obligation. It is not covered here. The only obligation which is covered is something which is by way of contract with the other person. That's the only focus in step number one. Then you go to the step number two. After identifying that the obligation is contractual in nature, you need to focus on the mode of payment. And as of now, I've given you that there is an exhaustive list of the mode of payments. Either the payment is made in cash or the payment is made in own equity shares. The company uses its own equity share as a currency note for the purpose. Now, one thing again, we need to put a focus is that if the mode of payment is cash, we're not going to outrightly call it as a financial liability. We're going to first of all dig and find out that is it unavoidable in nature or not. We need to see that we've got an unavoidable obligation to pay. So if there is an unavoidable obligation to pay, we say, yes, we've got an unavoidable obligation to pay. It becomes a financial liability. And if you say, no, it's not unavoidable in nature, it's discretionary in nature, then it becomes an equity component to that extent. So I think the focus is more on that if the mode of payment is cash, don't say it's a financial liability. You need to dig further and look at the concept, it's mandatory or discretionary in nature. And then we went to the step number three, and we said if the mode of payment is equity shares, you need to go to the step number three. And there I gave you a very simple test with logic. And I said that in terms of equity shares, you need to conduct a test which is called a fixed test. You need to basically decide that in order to discharge the obligation, the company is going to issue a fixed or a variable number of equity shares. So if it is a fixed number which is predetermined, remember it's not a predetermined formula, it's a predetermined number. So you need to consider that the number is being pre-decided. If it is fixed in nature, then it becomes equity instrument. But if you're issuing a variable number of equity shares, then in that case, it becomes a financial liability. And I gave you the logic as well, that by giving a fixed number of shares, you're indirectly passing on the risk to the holder. And when you're giving variable number of shares, the issuer is keeping the risk to itself, and it would become, you can say, outside funds, that is a financial liability. So this is what we have discussed so far, and I hope everybody is pretty clear with this case, right? I hope no questions at this stage. I guess everybody is pretty clear with our discussion so far on this. Okay, so I think now let me take it further. So having understood this, now I'm going to take the journey forward. I'm going to now expose you to more things. I'm now going to introduce another concept to my three-step model, and then I'll give you the final version of my model. Okay. Now, before I take you further, there is something, which I said yesterday is not technically correct in terms of my chart number 1. Because based on these three-step models, I have given you a total of 3 charts. The chart number 1, which I gave you, where the mode of payment is purely cash. Then I gave you a chart number 2, where the mode of payment is purely equity shares. And then I give you a chart number 3, where the mode of payment is both cash as well as equity share. Now, if you remember, I gave you something in chart number 1, and I said, there needs a little more discussion, which we'll do later. But we're still keeping it pending for some time, that what was something which I had to give you in the chart number 1. But let's, I think, first of all, get on to more additions in this case. Now, before I take the journey forward and make an amendment to my 3-step model, I want to make now a specific discussion with regard to what we call derivative. I'm just going outside this particular 3-step model, and I'm going to make a discussion with reference to what is a derivative. Now, I know most of you might be having a knowledge with regard to derivatives, and I think many of you may not be having a knowledge on derivative as well. So maybe, I think, irrespective whether you have the knowledge or not, let me still give you a clarity with regard to the concept of a derivative. Now, when I look at the term derivative, what comes to my mind is the English word derives. So the word derivative is come from the English word, what we use, derives. I think let me take a very simple example to explain what is a concept of a derivative, that it derives its value from where. Imagine that I buy, let's say, a ticket to a particular show. Let's say I buy a physical ticket for a particular show, and let's say the ticket is costing me, let's say, 450 rupees. I buy a ticket for a particular show, and I need to pay 450 rupees and get the ticket. So you pay that 450, you get a ticket, and it's like a physical delivery. Now, let's say somebody gives me a pass for that particular show, and I got this pass, and it is written on the pass that it is transferable. I know that when you get a pass, it cannot be transferred. But let's say this time I got a pass, and it very clearly says that this is transferable. If you want, you can transfer that pass to somebody else. Now, I have a very simple question coming to the mind. Let's say, for example, I want to transfer this pass to somebody else, and I want to do this for a consideration. I don't want to give this pass free of cost to somebody, but I want to do this for a consideration. Then what will I ask? I guess you will agree that if this particular movie is a hit, let's say if this movie is a hit, I think I would be able to charge for this pass anything which is 450 and above. I think you'll definitely agree that if this movie is a hit, I would definitely be able to ask the person to pay me at least 450 because it is available at 450 in the market. And maybe if the tickets are not available, I could ask the person to pay a premium, and I would ask him to pay something more. But let's say the movie has not been a hit, it's being a flop show, then I think the value perhaps you might be able to derive might be definitely below 450. Now, what exactly might be the value is difficult to predict. but I think if the movie is not a hit, then we can definitely say that you will be able to get less than 450 from the other person. I guess I'm making complete sense. So, which means that when you're looking at the value of the past, now hear me carefully. When you're looking at the value of the past, can I say the value of the past is getting its value derived from the ticket price? The past is able to determine its value, and its value is getting derived from the ticket price. So derivative has got one important characteristic. Derivative has got one important characteristic, that it derives its value. It derives its value from an underlying asset. It derives its value from an underlying asset. This is one characteristic of a derivative. I'm not saying this is the only characteristic, mind you. I'm not saying that this is the only characteristic. This is one characteristic of a derivative, that it always derives its value, you can say, from the underlying asset. Right? I hope I am pretty clear on the first characteristic of a derivative, right? I guess pretty clear on this. Okay, so we made a point that when you look at a derivative does not obtain its value independently. The value is obtained by help of an underlying asset. So in my example, the past is deriving its value from the ticket price. So that is one characteristic. Second, when you look at a derivative, there is another two characteristics as well. The second characteristic is pretty easy, that as far as the initial investment is concerned, as far as the initial investment is concerned, it is either zero or it is negligible. It is either zero or it is supposed to be negligible. So either we are making a very small amount of investment at 0 point of time when a contract is entered into, or when the instrument is issued, or it is practically a zero investment. And the third characteristic is that the settlement is going to take place in the future. There will be a future settlement of this particular instrument or this particular contract. So before you reach a conclusion that a particular contract, or if you say a particular instrument, is derivative in nature, then in that particular case, you need to fulfill all three characteristics. Mind you, you need to fulfill all the three characteristics. Even if one of the characteristic is missing, it is not considered as a derivative. So if you call a particular instrument, if you call a particular contract as derivative in nature, you need to prove the three characteristics. First of all, prove that the value of this instrument or the value of the contract is derived from the underlying asset, one. Initial investment is zero, that is, or negligible, two. And number three, that you're going to make a settlement at a future date. I guess I'm pretty clear on my three characteristics on a derivative instrument. Okay. I think I got some inputs from Kaushik as well. You said in case of equity, there is no obligation to pay interest to principal, so step one will directly fail. Well, I would say that there is a contract, but yes, you've got no contractual obligation to pay. So I'm not saying that there is an absence of a contract. So we can say there is a presence of the contract, but there is an absence to, there is an unavoidable, not unavoidable, but avoidable obligation to pay. So I think it's not that I would say I've got no obligation. I would say there is an obligation, but it's a discretionary obligation. So I would not say that step one fails, right? I guess I made my point clear. So in terms of equity instrument, we are going to say that in this particular case, there is an avoidable obligation. Discretionary returns can be given. And yes, we've got an obligation to pay, but that would be at the time of liquidation of the company, that you would pay the share in the net assets, right? I guess you got your answer on that. Okay, now coming back to the picture. So we've done the three characteristics. As I said, I'm just working out of financial instruments for the time being. And I have suddenly, started my discussion with you with reference to derivative contracts. And I started explaining that what is a derivative contract, and I explained the three characteristics of a derivative. Okay, I guess, do you know what is futures, what is options, and what is forward contracts? Though I don't want to get into strategic financial management early in the morning, but I guess, are you aware in terms of future contract, options contract, etc.? Otherwise, I think I need to give you some inputs on that. So, any fair idea in terms of derivative contracts like futures, options, as well as a forward contract? Otherwise, I think I'll explain a bit, because we'll get a little more hang in terms of derivative before we merge this concept in terms of our standard. Okay, I think I didn't get much inputs on that, so I presume that maybe we need a little knowledge on that. So I think let's give you a little inputs now. So I am now taking an example of a derivative contract, which is commonly called as an option. I'm taking an example to illustrate one of the kinds of a derivative contract, which we call option. Now, let me explain this in a little detail. When you say an option, just to explain, let's take an individual, Mr. X, on one hand, and let's take Mr. Y on the other hand. I'm not taking a company, but I'm taking an individual just to illustrate my concept. Now, Mr. X approaches Mr. Y today. Mind the words very carefully. Mr. X approaches Mr. Y today and said that after a period of 6 months, I will buy, let's say, 1,000 shares from you. I will buy 1,000 shares from you of company ABC Limited. So Mr. X is entering into a contract with Mr. Y today, but he says that I will come to you after a period of 6 months to buy 1,000 shares of ABC, let's say at the rate of 120 rupees per share. So this is the contractual terms that Mr. X enters into the contract with Mr. Y. He entered the contract today and says that I will come to you after 6 months to buy 1,000 shares of company ABC at the rate of 120 per share. Now, for this particular case, you know what Mr. X will have to do? Mr. X in this particular case will pay a small amount of premium. Mr. X in this particular case is going to pay a small amount of premium, which is called an option premium. This option premium will be paid at time 0, which will entitle Mr. X the right to decide. Mr. X, after a period of 6 months, would be in a position to decide whether he wants to buy the shares from Mr. Y or not. It gives him a complete discretion to decide. It gives him a complete option to decide whether he wants to buy the shares or not. And for this purpose, he pays an option premium, which is going to be a nominal amount as compared to the consideration for the share. The consideration is 120 rupees per share. So he would pay a small amount of money so that it gives him a right to refuse that he wants to buy the shares from Mr. Y or not. Now, this is one thing. And since the contract is entered with the perspective of buying shares, it is technically called a call option. It is technically called a call option. So when Mr. X gets the right to buy, and since we're looking at the right to buy the shares, it is supposed to be called a call option. And remember, it's a call for Mr. X and it's a call for Mr. Y. Many people believe that it's a call for X and it's a put for Y. No. It's a call option for Mr. X and it's a call option for Mr. Y. Now, what Mr. X would say in this particular case, that it is a long position. It's a call option with a long position, which is indicating that he's got the right to buy. He may buy them or he may refuse to buy. So he's got a long position. Now, as far as Mr. Y is concerned, we'll say he's got a short position. We're going to say that he's got a short position in this case. So when Mr. X and Mr. Y entered into a contract, one person is going to pay a premium and that person takes a long position. The other person is going to receive the premium and he's going to take a short position. So remember, the person who pays a premium gets a long position, and the person who takes the premium, receives the premium, takes a short position, but the nature of the option is call for both of them. So we would say that Mr. X has got a long call, and we would say that Mr. Y has got a short call. So they're both under a call, but we can say a long call and a short call. So when you decide that is it an option which is a call, which is to buy, or is it an option which is called a put, which is option to sell, you need to see it from the perspective of Mr. X. You need to see it from the perspective of the person who pays a premium. So Mr. X pays a premium. So we're going to see the nature of the option, whether it's a call or put from his perspective. If he enters into the contract to buy shares, it's a call option. If he enters into a contract to sell shares, it is called a put option. I hope I've made myself very clear. So in this particular case, the terminology, I guess, is pretty clear to us. So we said in this particular case that Mr. X enters in a contract with Mr. Y, where Mr. X pays a premium. So he takes a long position and Y takes a short position. The contract is to buy the shares. To be seen from the point of view of X, it's a call option for X, a long call, and it is a short call for Mr. Y. Now, let's imagine what are they going to do after a period of 6 months. Now, let's say after a period of 6 months, Mr. X will start looking at the price of the share. So after the period of 6 months, he finds out that what is the market price of these particular shares. He is contracted to buy these shares from ABC at the rate of 120. Now, let's say the market price of the share is 150 per share. Now, Mr. X will start thinking, and Mr. X will start thinking that, okay, I have a contract to buy the shares at 120 from Mr. Y, and the same share is, in the market at 150. So he feels that he's got an opportunity to buy it from Mr. Y at 120 and then sell it in the market at 150. That's how he'll start thinking. He will say, okay, I've got a good opportunity. Let me buy it from Mr. Y at 120 and then sell it in the market at 150. I stand to gain 30 rupees. So what he will do, he will go to Mr. Y and tell him that there are two ways we can settle the contract. One way is that you deliver me the shares. I'll pay you 120 rupees per share and you deliver me the shares. This will be a case of what we call physical settlement, where he goes to Mr. Y, pays the consideration 120 and asks for the share. It is called a physical settlement. The other option is that Mr. X tells Mr. Y that I don't want the shares. I've got the right to buy it from 120 from you, and then I'll get the opportunity to sell it in the market at 150. So let's do one thing. Let's settle it in cash. So he will say, you pay me the difference of 30 rupees. Because if I buy at 120 from you and then sell it at 150 in the market, I get the opportunity to earn the 30 rupees difference. So let's cash settle. So Mr. X, as per the terms of the contract, will get the option to either physically settle, that means pay the consideration and get the shares, or he would have the option to settle it in cash and just pocket the difference of 30 rupees. Now, let's imagine that the market price of these particular shares in the market is, let's say, 80 rupees. Let's say after the period of 6 months, the market price of these shares becomes 80 rupees. Now, Mr. X would start thinking that I have the right to buy the shares at the rate of 120 and the same share is available in the market at 80. So even if I'm interested in taking a physical delivery, I can just go to the market and buy the shares. What is a good need of buying the shares from ABC at 40 rupees extra? And Mr. X has got the option to say a no, because he paid a premium to Mr. Y, which gives him a right of refusal. And Mr. Y would in any case get the premium. The premium with Mr. X pays to Mr. Y is definitely belongs to Mr. Y. So irrespective, Mr. X exercises the right to buy or he refuses to exercise the right, then in this case, the premium definitely belongs to Mr. Y. So considering that the market price of the share is 80, Mr. X would say, sorry, I'm not interested in buying the shares from you, because he's got the right of refusal and he says, I am not interested to buy. So he would say that this option is not exercised, the premium is gone, but then he refuses to exercise. So I guess I've made myself clear on the concept of an option contract. So I think the key inputs, what you need to keep in mind is the person or the entity which pays a premium is supposed to be what you can say takes a long position. He gets the right of refusal, the right to decide whether he wants to exercise or not. The other person who gets the premium is called the person who takes a short position who gets the premium. He comes under an obligation. If Mr. X says, I want to buy, Mr. Y says, okay, you can buy, I'll give it to you. If Mr. X says, no, I don't want, Mr. Y will say, okay, don't buy. Mr. Y is under an obligation and Mr. X is under a contractual right. And I think you can understand that if Mr. Y is under a contractual obligation, that would make it a financial liability for him. And provided the parameters are met, and Mr. X has got a contractual right, so it will become a financial asset for him. Then we said that whosoever pays a premium, we need to see from his perspective that is it a call or is it a put? If you enter into the contract to buy, it's a call. If you enter into a contract to sell, it is supposed to be a put. So Mr. X is entered into the contract to buy. So it's a long call for him, and for Y, it's a short call for him. Call for both. Call for both, just the position differs. And Mr. X, depending upon the prices which will prevail after a period of 6 months, would decide that I want to buy the shares or not. So he would say, okay, if the price is increasing, he would be interested to buy. And in which case he can either go for a physical settlement, pay the money, get the shares, or he would do a cash settlement, settle just the difference. And if the prices goes down, then he is not interested in buying the share. Now, what is coming at the back of my mind at this particular stage is something like this. My question coming to the mind is, do you think that this kind of contract is going to fulfill the 3 features of a derivative contract? Let's, I think, apply this out. Let's see whether we're going to, meet the 3 characteristics or not. Do you think whether the option will be exercised or not? Whether the option will be exercised or not, is it dependent upon the value of the equity shares in the market? Yes. So this option will be exercised or not depends upon the value of the underlying asset, which is the equity shares of company ABC. Secondly, do you think there has been any initial investments which are made in the contract? Well, you would say that there has been an option premium which is paid. But the amount of option premium paid, as compared to the consideration for buying the shares is very small. It's negligible in nature. So we cannot say that the initial investment is huge. We can say, yes, there has been an initial investment, but as far as the premium is concerned, it is considered negligible in nature. And can we say that the contract is going to get settled at a future date because you entered into the contract today and the settlement will take place at a future? So yes, the future settlement will take place. So this has got all the characteristics of a derivative contract. And I think options is something which, if you've got a prior knowledge, everybody knows that as far as options are concerned, they're undoubtedly considered as derivative because they fulfill all the 3 characteristics of a derivative, that its value depends upon an underlying asset. Then we can say there is negligible investment at 0 point of time, and the settlement will take place 6 months hence. Right. So this is giving you about a call. But I think let's give you a little more clarity. I know what I'm doing in the morning. I think I'm teaching you, strategic financial management instead of financial reporting. But I think it's necessary because as we go to dig in terms of financial instruments, a little knowledge on a derivative is also required. So I don't want to take chances. And I thought I'll just give you a little brief on the concept of derivative as we move ahead. So let's, I think, take you to the similar kind of example and understand a put as well to get a clarity on both the ends. Now, let's take another example. Now, this time Mr. X approaches Mr. Y and Mr. X approaches Y and tells him, he approaches him today and tells him that after 6 months, I will come and I will sell you 1,000 shares. I will come and I will sell you 1,000 shares at the rate of 120 rupees per share. So he enters into the contract today and tells him that I will come to you after 6 months and sell 1,000 shares at the rate of 120 per share at a future date. Now, Mr. X pays a premium to Mr. Y as of today, which will give him the right of refusal, which will give him the option to decide whether he's interested in selling the shares to Y, or he says, no, I don't want to sell the shares. So as I said earlier, let's, I think, pinpoint this. Can I say, if I look at from the point of view of Mr. X, he pays a premium. So he takes a long position. He pays a premium, he takes a long position. Mr. Y receives the premium, so he takes a short position. And as I said, we need to look at things from the point of view of the person who pays the premium. Mr. X enters into a contract to sell the shares, so we can say it is supposed to be a put option. So we can say it's a long put for Mr. X, and we can say it is a short put for Mr. Y. So we need to see the position, whether it's a long or a short, depending upon who pays a premium. The person who pays the premium takes a long position. The person who receives the premium takes a short position. And then we need to see from the point of view of the person who paid the premium, is he entering into the contract to buy its call? Is he entering into contract to sell? Then it is supposed to be put. So it's a long put for X and it's a long put, short put for Y. Now, let's consider some more data and see what is the status going to be. Now, let's imagine that in this particular case, after a period of 6 months, let's say the market price of the share in the market is, let's say, to the extent of 150. So let's say after a period of 6 months, the market price of the share turns out to be, let's say, 160, 150. Now the question rises, would Mr. X be interested to sell? Mr. X entered into the contract to sell the shares at 120 to Mr. Y. And now the market price in the market is 150. It's better he sells it in the market, no? Why would he sell to Mr. Y at 120 if the same item is saleable in the market at 150? So he would refuse to sell. He will tell Mr. Y, sorry, I'm not interested in selling this, but whatever premium I give you, you can keep the premium. The premium in any case belongs to Mr. Y, irrespective Mr. X exercises or he refuses to exercise. The premium in any case goes to Mr. Y. But let's imagine if the market price of the share is, let's say, to the extent of 80. Now, do you think Mr. X would be interested in selling these shares to Y? Yes, of course. Because now Mr. X knows that if he sells it to Mr. Y, he gets 120. But if he sells it in the market, he would get only 80. He will definitely go to Mr. Y and tell him, boss, take these shares and give me 120 per share, which is called physical settlement. Or alternatively, he could tell Mr. Y that, boss, I am not going to sell the shares. Let's do one thing. The share is available in the market at 80. So I would technically, let's say, go to the market, buy it at 80, and then sell it to you at 120. So you can give me the difference of 40. It becomes a cash settlement. So either he does a physical settlement or he does a cash settlement where he tells the other person that let's settle for the difference, 120 versus 80. You pay me that 40 and we settle the contract. And I think it is implied, I don't want to say that, I think it is implied that this kind of contract is again a pure derivative, because the value of the option is being derived from the underlying value of the share. There is no initial investment except the premium, which is negligible. And the settlement is going to take place in the future as well. So this is one kind of a derivative contract. So if you're able to fulfill the three characteristics of a derivative contract, we can undoubtedly say that it is a derivative contract. I hope I've made myself very clear on the agenda, I guess. Are we pretty clear on this particular case? You got any questions on derivative? So then I think we can take the journey forward. Okay, so I think the moral of the story at this particular stage, and the moral of the story is like this. I started my journey in terms of a derivative. I've just been talking a little different as compared to the three-step model. We will link this concept to the concept of financial instruments. But I think I've given you now that there are certain instruments, there are certain contracts which are called derivative in nature. And they've got three characteristics. If you're able to fulfill all three characteristics, it is derivative in nature. Now, I've got a question to you. Let's see if you can answer this question or not. Let's say a company issues a share warrant. Let's say if a company issues a share warrant, do you think it is a derivative? Let's see what do we get in the answer. If you say that there is a share warrant issued by the company, do you think it is supposed to be a derivative? Waiting for your inputs on that. If you say that a company issues a share warrant, do you think it is supposed to be a derivative? Okay, I think I still didn't get much answers on that. So I presume that let me take it further. I think not many of you are clear that whether a share warrant is a derivative or not. So let me, explain this to you. So I'm just coming back on the inputs and let me, give the details on this. So I think what I need to do, I need to ask myself those three questions itself to decide whether it is fulfilling the three characteristics or not. Let's put across these questions to ourselves. When a company issues a share warrant, a share warrant entitles the holder that he can buy shares at a future date. It gives the holder an option to buy the shares at a future date at a given price. So the company would issue a warrant today and it'll entitle the holder to buy the shares and it'll give him an option to buy the shares at a future date by making a certain amount of money. He would pay a certain amount of money to buy those particular shares. Now, the question arises, number one. Do you think whether the holder would exercise the share warrant or not, is it dependent upon the price of the equity shares? Yes, of course. Whether the particular holder will exercise this right or not is dependent upon the price of the share. So the warrant is deriving its value, you can say, from the value of the equity share. The first characteristic is met. The second characteristic is that is there any initial investment which is done? Do you think the company took any consideration from the holder at time zero when they issued a share warrant to him? No. So there was no initial investment which took place at the beginning, at the inception of the contract. Then number three, do we say that this contract is going to be settled at a future date? Yes. The contract is definitely going to get settled at a future date because you issued a warrant today, which will entitle the holder to decide at a later date whether he wants to do the settlement in the future. So all the three characteristics are met. If all the three characteristics are met, we can definitely conclude that a share warrant is definitely supposed to be a derivative instrument. I hope I'm making sense on my analysis. So the idea of exposing you to the concept of derivative is that there could be an instrument which can be a derivative, which is going to have a total of three characteristics in nature. Okay, so I think I've got some inputs now. Somebody said a no, somebody said a yes, but I think now you've got your answer. Okay. Now, friends, having elaborated the concept of derivatives to you, having given you the exposure in terms of derivatives to you, the three characteristics, now I'm going to make my amendments to my three-step model. Now, this is going to be slightly technical, but trust me, you will get a good hang on the concept if you hear me well. I think it's going to take me with logics another maybe half an hour or so, maybe at least around a half an hour or maybe less, depends. But then after that, I will be able to give you a complete final draft of my three-step model. And we will do some questions also from the study material on that. But now for the next half an hour, hear me very, very carefully. Hear each and every word very carefully, because what I'm about to tell you is going to be, very important, and your conceptual clarity all depends upon that. So let me begin the journey. Now, the first thing which I'm about to tell you is very important. When a company issues a financial instrument, mind the words very carefully. Hear each and every word very carefully. So we're hearing it very carefully. I know that. So when a company issues a financial instrument, the financial instrument could be a non-derivative instrument. Yesterday when I took examples with you and I did illustrations with you in the study mat, trust me, they were all non-derivative contracts. The three charts which I gave you yesterday was based on all the contracts which were non-derivative in nature. I know you would say, sir, we never knew that there is a concept of a derivative. So how do we know that those questions were related to a non-derivative contract? Well, I think if you go back and look at those questions, none of those questions will fulfill the three parameters, the characteristic which I gave you for a derivative contract today. So when a company issues a particular instrument, when a company issues a particular contract, it can be a pure non-derivative contract. So the three charts which I gave you were based on a non-derivative contract. The company could issue a contract which is purely derivative in nature. A company could issue a contract which is purely derivative in nature, which I explained today. And I'm going to give you one chart on this today. I'm going to give you one chart on this today, that when you issue a financial instrument, it is purely derivative in nature. Like, for example, a share warrant. What we just saw is a case of an instrument issued by the company, which is a pure derivative in nature. Then there can be another very interesting contract, and that is that it has got both a non-derivative element and it has also got a derivative element. Now, these kind of contracts is what we technically call hybrid contracts. These kind of contracts is what we technically call hybrid contracts. This is a contract, what we technically say that there is a derivative which is embedded within the contract. So this contract has got two components. One is a non-derivative component and one is a derivative component. We say that there is a derivative which is embedded. You can say it is included. In technical words, we say that there is a derivative embedded in the contract. And I'm going to make one chart on that, and that will give me a total of 5 charts. So as I said, I promised yesterday that I'm going to give you a total of 5 charts in order to understand the concept of classification of the instrument from the issuer point of view. So I think let me put this once again. So when I say that an issuer company issues a particular instrument, there can be 3 kinds of instrument. An instrument which is a non-derivative instrument. An instrument which is a derivative instrument, which has got all the 3 characteristics of a derivative. And then there is another kind of contract which has got both a non-derivative and a derivative element. And these are called hybrid contracts. So when you say they're hybrid contracts, it means that there is a derivative which is embedded within the instrument. So we're going to do a little separate study later as well on this concept when we say that there is a derivative which is embedded in the contract. There is an embedded derivative in the contract. So this contract includes a derivative included, embedded within the contract. And there are certain requirements which are given in Indus 109, which tells me that you need to remove the derivative which is included in the contract. But all that later. So right now, my focus is going to be on a derivative contract. So I'll give you a chart on that. And then there is derivative and non-derivative, a chart on that. But I think first we need to understand a little amendment to my three-step model. So I'm now going to amend my three-step model and I'm going to amend my third step. So I'm coming to amendment to the third step. I've done the amendments to step 1. I've done the amendments to my step 2. Now I'm making amendments to my step 3. Now watch this carefully. Watch this carefully because this is again slightly technical area in nature, and no worry, you'll get the logic on this definitely for sure. Okay, I think Pradeep, you said initial investment required for a share warrant. No initial investment would be required. When a company would issue a share warrant, the company would not ask the holder to pay any consideration. So there is no consideration in terms of a share warrant. Zero investment at time 0. Unlike option contract where there is an initial investment in terms of a premium. Okay. Now let's get this amendment to step 3. I said that in step 3, if the mode of payment is equity share, this is what I said in step 2, that if the mode of payment is equity shares, you need to go to the step number 3 and apply a fixed test. Now I make my amendments. Now, if the mode of payment is equity shares, you need to first of all decide the nature of the contract. You need to decide the nature of the contract. You need to decide that is it supposed to be a non-derivative? You need to decide that is it a non-derivative, or you need to decide that it is derivative. So I made a change in my step number 3 very carefully. So if the mode of payment is supposed to be equity shares, we will not jump to the fact that there is a fixed test. We need to decide, first of all, the nature of the contract. And I think now you would have realized that why in the morning I started explaining you about derivatives. Because I want to link the concept of derivative to my step number 3. So you need to decide in step number 3 that what is the nature of the contract? Is it a non-derivative or is it supposed to be a derivative? If it is a non-derivative, you would apply the fixed test, what we did yesterday. We're going to apply the fixed test. But if it is a derivative, the standard tells me to apply a new test, which is called a fixed for a fixed test. We're going to apply a different test in this case. It is called a fixed for a fixed test. In short form, we can call this as F for F, fixed for a fixed test. Now, don't get worried on what is this fixed for a fixed test. We'll understand. So you need to first of all decide in step 3, what is the nature of the contract. If it is a non-derivative, you would apply a fixed test. But if it is a derivative, you need to apply a fixed for a fixed test. Now, what do we do in terms of fixed test? In terms of the fixed test, you look at the number of equity shares to be issued. You look at the number, that is the number of equity shares to be issued. Is it fixed? Or is the number of equity shares to be issued, is it variable in nature? And we've already seen that if it is fixed, then it is equity instrument. And if it is variable, then it is financial liability. We've already seen that. Now the question rises that when I say fixed for a fixed test, there are two things to be seen. One is what we call the consideration. There are two things to be seen. One is called the consideration. And the other thing to be seen is the number. So we need to see that the consideration the issuer will receive is fixed. The number to be issued against that consideration is fixed. I repeat. When you look at a derivative instrument, there are two things to be seen. You need to consider the consideration which you receive as an issuing entity should be fixed, and the number to be issued against that consideration is also fixed. If both the consideration and the number is fixed, if both the consideration and the number is fixed, it is called equity instrument. If any one is supposed to be variable, any one is variable, whether the number is variable or the consideration is variable or both are variable, any one or both are variable, then it becomes a financial liability. Sir, logic. Sir, logic. Don't worry, I'll give you the logic as well. But I think first let's get a clarity of thought. So this is getting technical as well. I know. I very well know that it's getting technical, but it's very interesting at the same time. So I think let's get the picture once again very clear. So I made my amendments to my step number 3. And I said that when the mode of payment is equity shares, you cannot decide the test immediately. You need to first of all decide the nature of the contract. You need to first of all decide. So if the mode of payment is equity shares, you need to decide is it derivative or non-derivative. If the mode of payment is cash, you don't need to decide that. If the mode of payment is cash, you don't need to decide that. Because in terms of mode of payment being cash, the only thing to be decided is the avoidable or the unavoidable test. But if the mode of payment is equity shares, you need to decide, is it a non-derivative or is it a derivative in nature? Because that will decide the type of test to be conducted. And the standard has made it very clear that when it is a non-derivative contract, you will apply a fixed test, which we learned yesterday. But if it is a derivative contract, you need to first of all decide that there is a fixed for a fixed test. You need to decide the consideration received is fixed. You need to decide that the number to be issued is fixed. If the consideration is fixed, the number is fixed. Both are fixed. It is equity instrument. The consideration is variable, the number is variable, or both are variable, then it becomes a financial liability. So, but we need to understand the logic. Then why are you saying in this particular case that, we need to apply a fix for a fixed test and then accordingly decide it's a financial liability or equity instrument? Okay, I think now let's explain the logic to you. But I think first let's take an example to understand the derivative characteristics, fix for a fix, then I'll give you the logic as well. So let's do one thing. Let's first of all take you to a very simple example. And I think you can help me in terms of deciding that is it a financial liability or is it supposed to be an equity instrument? A company issued a share warrant. A company issued a share warrant, and I've already explained that it is a derivative because the value of this depends upon the underlying value of shares, 1, no initial investment, 2, future settlement, 3. So it is undoubtedly a derivative. So the company tells the holder that every one warrant, they say that every one warrant will entitle you to 2 shares. The company very clearly tells the holder that every one warrant will entitle you to 2 shares and you will be able to buy each share at the rate of 25 rupees per share. The company very clearly tells the holder that you will be able to buy for every one warrant 2 shares at the rate of 25 rupees per share. Now let me apply my fixed for a fixed test because it is a derivative. So we are looking at the mode of settlement is equity share. So we are looking at the step number 3 that we need to apply the fixed for fixed test. So let me put the question on that, is the number and is the consideration fixed or not? The issued company says, what is the consideration to be received? It is 25 rupees per share. So the consideration to be received is fixed. Yes, the consideration is fixed. And the number for every one warrant, two shares, it's fixed in number. The number of shares to be issued against the warrant is fixed. And if the number and the consideration is fixed, therefore we can say it becomes an equity instrument. The consideration to be received against the warrant and the number of shares to be issued against the warrant is fixed in number. Since it is fixed in number, it becomes an equity instrument. Sir, but the logic, don't worry, I'll give you the logic as well. But I think at least we're learning the art of applying the fixed for a fixed test. That the consideration is fixed, the number is fixed, therefore it becomes equity. Had the number been variable, had the consideration been variable, or both have been variable, then it would have been classified as a financial liability. Okay, so you want to know the logic as well. You want to understand the logic as well, that why in this particular case we are calling this, why we are applying a fixed for a fixed test. I think we understood the concept of a fixed test yesterday. You want to understand the concept of the fixed for a fixed test as well? Yes, sir. Okay, so let's get ready to understand why do we apply the concept of a fixed for a fixed test. Now, hear me very carefully. Let's consider that there is a non-derivative contract, and let's consider there is a derivative contract. Very simple, plain vanilla question which is coming to the mind. I'm keeping a non-derivative on one hand, where we said we apply a fixed test, and we said that in terms of a derivative, we would apply a fixed for a fixed test. Now let's understand the two elements. One is the consideration, and one is the number. So there are two parameters which I am evaluating. One is the consideration and one is supposed to be the number. Now, let me put across a question to myself. When a company issued a non-derivative contract, let's say, for example, a mandatorily convertible instrument. Now, if you remember the examples which I took yesterday, I took the example of a mandatory conversion. So, but where was it written in the question that it was a mandatory conversion? Well, I think if you get back to those illustrations which I showed you, illustration 15 as well as illustration 16, you would notice in the language, it said that we are going to convert it to equity shares. So it was a clear-cut case where it was a case of a mandatory conversion. And if it is a case of a mandatory conversion, it was a non-derivative instrument. So in that particular case, now let me ask you, did the company receive the consideration when that instrument was issued? Did the company receive the consideration when the instrument was issued? Yes, the consideration was already received at time zero. When the instrument was issued, the consideration was already received at that time. But the company, the issuer company, can I say, would be issuing the number of shares at a future date. So the number of shares to be issued was related to the future. So the consideration did not relate to future. The consideration did not relate to the future. You'd already received a consideration when you issued a mandatorily convertible instrument. But it is only the number which was supposed to be issued at a later date. But look at a derivative, for example, a share warrant. Have you already received the consideration, or will you be receiving the consideration at the future? We will be receiving the consideration in the future. And as far as the number is concerned, are we also going to issue the shares against that consideration in the future? Yes, the number of shares to be issued will also be in the future. So what are the two elements which relates to the future? Can I say in a derivative, it is the consideration and the number which both relates to future? The consideration also relates to the future. The number also relates to the future. So we are looking at a fixed for a fixed test. We're looking at a fixed for a fixed test because the consideration relates to the future. The number relates to the future. But in terms of a non-derivative, what relates to the future is just the number. If it is just the number, we are applying a fixed test. I don't know if I'm making good sense on that. If yes, send me an answer yes. Did I make good sense on the logic in terms of the fixed test and the fixed for fixed test? And if you want me to put it again, once more. You want me to put it once again, once more, but did you get the logic? Send me a message if you got the logic in this case. Am I pretty clear on my logic in terms of the fixed test and the fixed for a fixed test? Do send me your inputs on that. So I think let me just put this once again. I know what I'm speaking today is very technical indeed. But don't worry, we will do a little consolidation towards the end as well, mapping the entire concept to you once I come to my three-step model. This will give you a good hold in terms of things, right? Did I make sense? Please send your inputs to me so that I can understand, what you got the logic in terms of the fixed and the fixed for a fixed test. In the meantime, let me just consolidate the learning. So I have now given you another amendment to my step number 3. I've given you another amendment to my step number 3. And I think, let me just come to my amendment. And I think I got your inputs. I think Kaushiki, Nidhi, Aniket, wonderful indeed. Okay, so let's, I think, take this journey forward. So we are saying that when you are looking at the step number 3, yesterday we said that if the mode of payment is equity share, apply a fixed test. Now amended. Now I've amended. I said, now you need to first of all decide the nature of the contract. So what I've done, I've gone very systematic with you since morning. In the morning, what I did, I exposed you to the concept of the 3 characteristics of a derivative. That's what I did in the morning, that I introduced you to the concept of a derivative, exposing you that derivative has got 3 characteristics. That's one. Then what I did, I said that there are 3 kinds of instruments the company can issue. That's what I exposed you. I said that there is a non-derivative contract for which I've already done my things with you yesterday, made 3 charts. Then there is a derivative contract, which I'm yet to make a chart with you. And then there is a contract which we said is a blend of a derivative and non-derivative, which I said is called a hybrid contract, and which I'm going to make 1 chart today. So we're going to first work on a derivative. Right now, we're working just on a derivative. We'll be working on a derivative and non-derivative combined later. So with this input, I made my amendment to the step number 3. So when the mode of payment is cash, you need not worry whether it is supposed to be a derivative or non-derivative. I'm not concerned. It is only when the mode of payment is supposed to be equity shares, then you need to consider the nature, that whether it's a non-derivative or derivative in nature. You would apply the 3 characteristics and decide that is it a derivative or not. If you meet all 3 characteristics, it's a derivative. Otherwise, it's a non-derivative contract. Now, once you decide that it's a non-derivative contract, you need to apply a fixed test. Just look at the number of shares. And if it is fixed, it is equity instrument, otherwise a financial liability. But if it is a derivative contract, you need to apply the new test which I gave you, that is called a fixed for a fixed test. The fixed for a fixed test has got 2 portions. One is that the consideration to be received in the future is fixed. The number to be issued against that consideration is fixed in number. If both the consideration and the number is fixed, it is called an equity instrument. And if any one or both are variable in nature, then it becomes a financial liability. So we thought, let's understand why did these standard setters, consider the concept of a fixed test for a derivative, non-derivative, and why did they consider a fixed for a fixed test for a derivative? The logic was simple. And we are looking at that there are 2 parameters. One is the consideration and one is the number. So you need to very carefully analyze that when it is a non-derivative contract, the company issues the instrument today and you get the consideration today itself. A company issues a mandatorily convertible instrument, the consideration is already received at time 0. So it doesn't relate to the future, the consideration is already received. But the number of shares to be issued against that consideration is something which relates to the future. So the only component which relates to the future is the number when it is a non-derivative contract. But if you look at a derivative contract, you can say that the company says, okay, you will give me a consideration in the future. I will give you the shares against that consideration in the future. So both the number as well as the consideration relates to the future. And if it relates to the future, then we are looking at both the consideration and the number. Because what relates to the future for a non-derivative is just the number. And what relates to the derivative is not only the number, but also the consideration. Wow. So I think now we have well understood with logics how we are going to look at things. So I think now I should first make my chart number 4 with you, which is on a pure derivative. So I think let's do the honors, and I think let's create a chart on this. I personally believe that the step-by-step approach always helps us in learning things better, because our mind is, start thinking on a very systematic end. Though there are principles to be applied within each step, which I said yesterday, giving you a step doesn't mean that we are studying a rule-based accounting. Giving steps is only to ease the learning. So what I've done, I've created step-by-step models on learning, and you're going to see a lot of 3-step models coming in this particular standard. So I've just converted, the entire journey on Index with my own level of research, making it a step-by-step approach for easy learning. But of course, step-by-step, to caution, doesn't indicate a rule-based accounting anyway. Because, people tend to believe that if it is a step-by-step approach, it's more like a rule-based accounting. No, it's not rule-based accounting. We are still on a principle-based accounting itself. We're applying logics, we're applying things in between the steps as well. Okay, so let's come back now. So I am now taking my chart number 4. I'm taking my chart number 4. And in this chart number 4, let me tell you now, since we have learned the concept of a derivative, non-derivative, this chart is on a derivative. That is 1. It's a pure derivative. And I am considering the mode of payment to be equity shares. So this is my focus point in chart number 4, that I am considering derivative and I'm considering the mode of payment to be equity shares. So after this chart, we'll take an example from the study material as well. So in this particular case, one thing is pretty clear, that if it is supposed to be mode of payment equity shares and a derivative, we definitely need to apply a fix for a fixed test. We definitely need to apply a fix for a fixed test. So in this particular case, let's consider the consideration. Let's consider the different permutation combinations, consideration, as well as the number. And I will decide the nature of the contract, that whether it is equity instrument or it is a financial liability. So let me pick up all the permutation combinations in this case. Number 1, the consideration is fixed, and the number against it is also fixed. A company issued an instrument, a share warrant, for example, the consideration to be received is fixed, the number is fixed, so it becomes an equity instrument, undoubtedly. Because as I said, if you pass the fix for a fixed test, it is equity instrument. There is no risk because the consideration to be received is fixed. The amount of number of shares to be given against it is fixed. The risk is not on the issuer. The second is the consideration is fixed, and let's say the number is variable. And the third combination is that the consideration is variable and the number is fixed. And I think you can get a fourth combination as well. The consideration is variable and the number is also variable. There cannot be a fifth permutation combinations in life. So in this case, it's a financial liability. In this case, it's a financial liability. And even in this case, it is a financial liability. If you look at the study material as well, you'll see this very clearly. Such a chart has already been made in the study material, where they've given you that different permutation combinations of a fix for fixed test. And you can see that what I did, I took the consideration fixed and I took the number fixed and variable. I took the consideration variable and I took the permutation combination fixed and variable. So there doesn't seem to be any fifth permutation combination which is coming. So sometimes, we also call this, like the second permutation combination is called that it meets the fixed for a variable test. We also say the third one is we meet the variable for a fixed test. And we say that we meet a variable for a variable test. I mean, it's just looking at the same thing, with a different angle. When you say that you pass a fix for a fixed test, it's one thing, or you just say that you fail that test. Or you can say that you pass a fixed for a variable, or you pass a variable for a fixed, or you pass a variable for a variable test. In all those cases, it becomes a financial liability. Okay, so far so good on the journey. And I guess now let me just come back to you. And I guess let me just share the questions in the study material to you so we can have a little look at this. So I think I'm going to take a question now with you. This is a study material question, and this is the unit number 3 in the study material. This is the unit number 3, and I'm looking at the illustration number 17 in the study mat. So let me just read this to you, and we'll decide in this particular case. You can see that, we have mapped up illustrations of the study mat with each and every chart. So let's have a look out here. It says ST purchases an option from AT. Now, when you say that ST purchases an option from AT, that means ST must have paid a premium. So ST must have paid a premium, and it entitles the holder to subscribe to fixed number of equity share. So I can say ST is paid a premium where he wants to buy the shares from AT. So would you like to define that what is the position ST has taken? So we are saying that in this case, ST purchases an option from AT, entitling him to subscribe for a fixed number of equity share. It's a contract to buy. We can say it is a contract to buy, so it is supposed to be a call seen from ST's point of view. And ST is paying a premium to get this option, so he gets a long call. And I would say AT gets a short call. So this becomes a long call for ST, and I would say this becomes a short call for AT. So ST purchases an option from AT, entitling the holder to subscribe for fixed number of equity shares at a fixed price of 50 rupees per share at any time during a period of 3 months. Holder paid an initial premium of 2 rupees per option. Examine whether the financial instrument will be classified as an equity or not. Now, in this particular case, what we need to consider in this particular case is that we need to first of all consider that ST purchases an option from AT, which entitles the holder to subscribe for fixed number of equity shares at a fixed price of 50 rupees per share at any time during a period of 3 months. And there is an initial premium as well. So which means that one thing is very clear, that we are making the mode of payment as equity shares. So I want to apply my 3-step model and get the picture very clear. So let me, I think, start the journey. I think you would have already got your answer. And I think Aniket, you said a variable consideration, hence equity instrument. A variable consideration or fixed? Variable consideration or fixed? Okay, let's go with the 3-step model and apply this step by step. Since we're now on our clarity of thought, after this, I'm going to give you the final version of my 3-step model. So I think let me begin the journey. This is, I was reflecting the illustration number 17, and this is on page number 12.104. So we are on illustration number 17. That is the unit number 3 of the study material. And this is page 12.104. Now, let me begin the journey with my 3-step model. And we are looking at from whose point of view? Can I say I am looking at the things from the issuer perspective, that is AT. So we're looking at from the point of view of the issuer, that is AT Limited. So we'll put across the 3 questions to go with. Step number 1. We first of all identify, does AT have a contractual obligation? So the question rises, does AT have a contractual obligation? Yes. Since he's received a premium, he is under a contractual obligation to the other party. So there is definitely a contractual obligation. I go to the step number 2 and I decide the mode of payment. The mode of payment is equity shares. Then I go to the step number 3, and in terms of the step number 3, we now need to decide the nature of the contract. Before we decide the test, we need to decide on the nature of the contract. And in terms of the nature of the contract, we need to see, is it a derivative or a non-derivative? So let's apply the 3 characteristics and see whether it is fulfilling the characteristics of a derivative or not. So I think first of all evaluate this. Can you see AT got a short call position and the contract is entered today? The settlement will be 3 months hence. And the initial amount of investment is just 2 rupees, which is negligible compared to the consideration of 50. And whether the other person, ST, would exercise the shares or not, is it dependent upon the value of the shares? Yes, undoubtedly yes. So I think if I'm looking at, is the value of this particular contract deriving its value from the underlying asset? Yes. Is the initial investment zero? Not zero, but I would say it's negligible. And then I look at the third factor, that is there going to be a settlement in the future? Yes, the settlement will be anytime 3 months from now, anytime within 3 months. So there is a future settlement, which proves that yes, it is undoubtedly a derivative contract. And once you say that it is a derivative contract, we would decide, let's apply a fixed for a fixed test. Let's apply a fixed for a fixed test, in which particular case I would say, okay, let me check my consideration and let me also check the number. And I think if I now apply the test, we know that the holder will be able to get fixed number and it will be for a fixed price, that is 50. So the number is supposed to be fixed and the consideration 50 is supposed to be fixed. That means if both are fixed in nature, we can definitely say it becomes an equity instrument to that extent. Wow. So I think we would have got a complete feel in terms of things. Let me still read out the answer to you. For the issuer AT, this option is an equity instrument as it will be settled by a fixed amount of cash for a fixed number of own equity instruments. You will meet the fixed for a fixed test. Then he says, if on the other hand, just to give you the other position, if on the other hand, if the exercise price of the option is variable, say it is benchmarked to an index of variable other than the market price of the equity share, the written option will be classified as a financial liability, indirectly saying that if the consideration becomes variable, so anything, rather the consideration or the number becomes variable, then it will become a financial liability from the point of view of the issuer, that is AT. Okay, so I think this brings me to an interesting position, and I think that's wonderfully said. Okay, so I think now I am ready with my final version of things. I think it's now time to do a consolidations of a learning, but I think before that, I want to understand, I think since you've been connected since yesterday and we've learned things on this, what do you think is your comfort zone so far? Are you feeling good? Are you feeling very comfortable? What's your comfort zone? I just want to understand your thoughts. So in the meantime now, I think I want to also draft my final version now. I think I'm giving you 2 exposure drafts. Now I think I'm moving to my final version of my 3-step model. As I said, now it's time to reach a final model in terms of things. So let me, I think, come to the final version. So I'm putting this now. This is my 3-step model now. And this my 3-step model, this is the final version. Don't worry, now it's not going to mutate. The final version is ready. So COVID is gone. My final version is also ready. I've done 2 mutations of my model. So this is finally the final version coming in. Okay, I think Karnika tells me very comfortable, wonderful indeed. Koshiki tells me comfortable, very good, interesting, beautiful. Okay, so now let's make a note. So you can please note it down as well. Now I'm going to combine all the learnings in this case in the three-step model. So I think let's begin with the step number one. So the step number one, what I need to put across the question is there a contractual obligation? Is there a contractual obligation? That is the first question, the first step we need to apply ourselves, that is there a contractual obligation? And the moment you go to the step number one, there are two things which should trigger in your mind. One is the word contractual, and the other is the word obligation. So the moment you look at the step number one, what should immediately come to your mind is that obligation has got two components. Immediately what should come to the mind is that obligation has got two components. One is the principal component, and one is the return component, which is in the form of interest or the dividends. And you need to immediately take a call looking at the facts of the question, that do you need to run this three-step model twice or once? So this element will give you a decision that do you need to run the three-step model twice or not. This will only give you the insight that do we need to run my three-step model twice or not. So very carefully look at the facts of the case. And when you see that there are two different inputs given for the two different components, maybe the modes of payments are different. Maybe one of the component is mandatory, one of the component is discretionary. So you need to decide, looking at the information in the question, that whether we need to run a three-step model twice or not. Secondly, when you look at the word contractual, what comes to mind is that when we are looking at obligations, the obligations can be imposed by law. If it is imposed by law, we are not covering it in step one. The obligations could be self-imposed, what we said, constructive obligation. If it is self-imposed, we are not covering it out here. So we are only covering obligations which are by virtue of entering into a contract. So that's the focus point. That when you look at the step number one, you should be very clear that we're looking at an obligation which is not imposed by law. We're not looking at an obligation which is self-imposed. We're only looking at obligations where you entered into a contract and the obligation gets triggered. And the obligation has got two components. That's the final version of my step number one. Then we go on to the step number two. With this, we go on to the step number two after this. So we go to the step number two. And in terms of the step number two, you need to now decide that what is the mode of payment. So when you've decided that there is a contractual obligation, the next agenda is to decide the mode of payment. How are you going to make your payments? Now, in terms of the mode of payment, as I said, you can consider that there is an exhaustive mode of payments, what we've discussed so far. So that means you're going to make a little amendment to the step number two later, maybe. So you can say it's a final version, but there is one small little thing, which we'll discuss otherwise, but you can take it as a final version. But one thing which I definitely clarified at this particular stage was that one thing is clear, that the mode of payment cannot be goods and service. So one thing is very clear, that the mode of payment cannot be goods and service. So like, for example, a company gave a warranty and it tells the customers that, okay, I will give you, goods and services in return of this warranty obligation. That cannot be a mode of payment. So if it is a goods and services, definitely a big no. So the mode of payment is either cash, or the mode of payment is either equity shares. And as I just made a mention a while back, if the mode of payment is cash settlement, you don't need to bother, whether it's a derivative or a non-derivative. The concept of a derivative or non-derivative arises only when the mode of payment is going to be equity shares. So if you say the mode of payment is cash, you need to see that, is it unavoidable? You need to see that, is it unavoidable in nature? So we need to basically see that it is mandatory or it is discretionary. So if you say, yes, it is unavoidable, that indirectly means that the payment is mandatory in nature. That indirectly means that the payment is mandatory in nature. And if it becomes mandatory in nature, then it is certainly a financial liability. That component of your obligation is financial liability. And if you say, no, it's not unavoidable in nature, it is indirectly saying that it is discretionary in nature. And if you say that it is discretionary in nature, then it becomes equity component for the same. So the moment you pay a cash, we need to consider that there should be an unavoidable obligation to pay cash. It should be mandatory and not discretionary in nature. And then when you look at the mode of payment being equity shares, then you go to the step number 3. Then we go to the step number 3. So this is my step number 2, the final version, that there are basically 2 modes of payments. Either the company pays a cash or the company uses its own equity shares as a currency note for the purpose of making a payment. And then we go on to the step number 3. So now we made some amendments to the step number 3, and this is my final version of my step number 3 as well. And I would definitely, request all of you today that, do practice the questions, what we've done yesterday and today, because now you'll be able to look at the same questions, with a little different perspective. Because now you've got a hand in terms of, the entire final version of the 3-step model. So you'll be in a very better position to get your concepts clear, that when you look at the question, that is it derivative, non-derivative, etc. Okay, now coming to the step number 3. And this is, you now need to look at the nature of the contract. So once you say that the mode of payment is equity shares, now you need to look at the nature of the contract. And in terms of the nature of the contract, you need to first of all decide that is it derivative or not. You need to decide that is it a derivative or not. So the focus is going to be to decide that is it a derivative or not. And in order to decide that it is a derivative contract or not, what do you need to do? You need to look at the 3 characteristics. You need to look at the 3 characteristics of the contract. So whether the 3 characteristics are present or not, if yes, it becomes a derivative contract. And what are the 3 characteristics? Number 1, you need to prove that the value of the contract, the value depends upon underlying asset. The value depends upon the underlying asset. So you need to first of all see that the value of this particular contract is dependent upon an underlying asset. So it derives its value from another, you can say, asset. And we should be able to prove that the initial investment is either 0 or it is not 0, then it is negligible. Like, for example, in terms of an option contract, we said that in this particular case, it is practically negligible as compared to the consideration. And we should be able to prove that there is going to be a future settlement as well. So if you're able to prove all these 3 characteristics, that there is 0 investment or negligible, there is a future settlement, and the underlying value depends upon the underlying asset. So we can say, yes, all 3 are met. We say, yes, all 3 are met. You meet all the 3 conditions, then it definitely indicates that it is a derivative. It definitely indicates that it is supposed to be a derivative. But if you say any one fails, any one or more fails, so you are not able to pass all the 3, any one or more fails in this particular case, then it definitely indicates that it is a non-derivative in nature. So when you look at the nature of the contract, go systematic, look at these 3 characteristics. Are the 3 characteristics met or not? So if all the 3 are met, it becomes a derivative in nature, and any one or more fails, it's non-derivative. So once you say that, yes, it is a derivative, then it's time to apply a fixed for a fixed test. And if it is supposed to be a non-derivative, then it is time to apply for a fixed test. And now you know the logic as well, that why we're looking at a fixed test and why we're looking at a fixed for a fixed test. So when you say it is a fixed for a fixed test, you need to see two things. You need to see that the consideration is fixed. You need to see that the consideration is fixed, and you also need to see that the number is fixed. But in terms of the fixed test, you just need to consider only the number. The consideration is not to be seen because you've already received the consideration at time 0. So dependent upon this, we say both are fixed. We say both are fixed. So when you say both are fixed, then we've said it is supposed to be an equity instrument. Any one or both are variable. Any one or both are variable in nature. So any one of them is variable, or both are supposed to be variable in nature, then it becomes financial liability to that extent. And similarly, when you look at the fixed test, then we're just looking at the number is fixed or the number is variable in nature. So when you say the number is fixed, it becomes an equity instrument. And if the number is variable, it becomes a financial liability. So finally, my 3-step model gets created on this. We are able to now make a complete thought process in the mind that how I'm supposed to go in terms of the issuer perspective. Mind you, we're still on the issuer perspective. We've not seen this particular standard from the holder's point of view. A journey from the holder's point of view will practically start when we start looking at Ind AS 109. So we're looking at issuer perspective and looking at, is it supposed to be a financial liability? Is it supposed to be an equity instrument? Or is it supposed to be a compound financial instruments? So the 3 charts on a non-derivative is done. And I've also covered the 4th chart, which is on a derivative. Now what comes in is the chart number 5, wherein I need to talk about hybrid contracts with you. And when I'm looking at hybrid contracts with you, and it also reminds me that I also need to do a little rectification in terms of my chart number 1. You know, where I said that there is something which I need to amend in chart number 1. And along with this, I'm also going to do my discussion based on my chart number 5, which is hybrid in nature. So let me do one thing. I'm going to first of all, take this further. Okay, I think Kaushiki, you said, oh, screen was not visible, is it? Oh my God. Just give me a second. Just give me a second. I'll just run these notes to you once again. Oh, I didn't realize that. I'm so sorry. So let me just quickly run through this with you. I guess you can have a look at the 3-step model now, visible, right? Okay, Kaushik, you said solution of illustration 17, why other market price? Why is the other than market price written? Okay, I'll explain that. Maybe I'll just run through, first of all, the 3-step model to you. So as I said in my 3-step model, which is the final version, so I'm looking at, is there a contractual obligation? That is my step 1. Wherein I said that there are 2 focus points, contractual, obligation. So when you look at the word contractual, remember, if it is imposed by law, it's not covered in step 1. If it is self-imposed, constructive, not covered. If it is contract, yes, covered. Obligation has got 2 components. The moment you read a question, just take a call whether we are given supposed to run this 3-step model twice or not. So this is my step 1. Then I think let's go to the step number 2. And in terms of the step number 2, I gave the mode of payment. And I said goods and services cannot be a mode of payment. If you are going to make a payment by way of goods and service, we are definitely outside the purview of this standard. And basically, we can say there are 2 modes of payments. One is that the mode of payment is cash, and one is the mode of payment is equity share. If it is equity share, you go to the step 3. And if the mode of payment is cash, look at the unavoidable test. Look at, does a company have an unavoidable obligations to pay? If you say yes, it is an unavoidable obligation to pay, it's mandatory, it's financial liability. And if it is discretionary, then it is equity instrument in nature. And I think let me now run through the step number 3 as well. So in terms of the step number 3, if the mode of payment is equity share, you need to consider the nature of the contract. You need to decide, is it a derivative or not? So for that, I've given you the 3 characteristics of a derivative. So you need to first of all see that the value of the contract depends upon the underlying asset. Secondly, the initial investment is either negligible or it is zero. And thirdly, the settlement is going to take place in the future. So either you meet all the 3 or you fail any one. So if you meet all the 3 characteristics in this particular case, it is undoubtedly a derivative. And if you fail any one or more, then it is non-derivative in nature. Accordingly, you will be able to decide a test. So if you say that all 3 parameters are met, it is definitely a derivative. You need to apply a fix for a fixed test, where you need to see the consideration and the number is fixed. If both are fixed equity instrument, one or more, both are variable, it's financial liability. And if it is supposed to be a non-derivative, you apply the fixed test, just look at the number, is it fixed or variable, and accordingly decide, is it supposed to be equity instrument or a financial liability. Right, I guess you've taken a note on this, and that was my final version in terms of deciding that the nature of the instrument is equity, financial liability, or is it a compound financial instrument? Right, I guess you've all taken a note on this, I believe. Okay, wonderful indeed. Now, before I take the journey forward now, as I said that we will go to work on 5 charts. Now, very clearly, which kind of 5 charts I'm working on. I'm working in terms of 3 charts already done, non-derivative. I've done the chart number 4, derivative. Now it's time to work on the chart number 5, which is supposed to be hybrid contracts. But before that, I also said that, there was a little thing which I wanted to add on, amend in my chart number 1. So I think what I'm going to do, I'm going to first of all amend my chart number 1, wherein I give you something which I want to make an amendment now, because I think it's the right time to introduce that amendment. And then I'm going to work upon the chart number 5. So once that amendment is done, and once the chart number 5 is done, one major chunk of this particular standard would get done. But I think prior to that, I think we should give you a break as well. What do you say? A very good idea indeed. I know you must be technically tired as well. So I think we're going to give you a break of 10, 12 minutes at this stage as well. So we're going to see you after the break, friends, on this. So let's take a break now, and I'll join you back. Welcome back, friends. So I guess you had a good rest as well. I think it's equally important to give rest to the mind as well. So we'll start back now with you on things. And I think, Aniket, your sessions are amazing, sir. Step-by-step model is very helpful to me. Thank you so much. And Shubham, you said, sir, but the derivative is inherently contingent. So how is it recognized in the books of accounts? Okay. Now, I think you've got a very valid question in terms of how do we decide whether, how the accounting is done. But you would recall, as I said even yesterday, that when we're looking in terms of Index 32, it's more to do with the presentation part. No worries, we'll be coming to the accounting for a derivative later, because that's going to be a part of Index 109. So how the accounting of all these instruments takes place is going to be covered in Index 109. So the accounting part is going to be a little pending for the time being till we come to a switch over on Index 109. So it will be taken care of. Okay, so I think now let's take the journey forward. Having understood the three-step model with you, I want to first of all make a little amendment to the concept of my chart number 1. I think I'd like to draw your attention to the chart number 1, which we made yesterday. And in the chart number 1, if you remember, one of the components I said, one of the permutation combinations was that the principal was irredeemable. And as far as the return is concerned, I said it's mandatory. And I think if you recall, we had given this permutation combination that what is the nature of this instrument. And we called this as a compound financial instrument, right? If you just go back to the chart number 1, which we did yesterday. So I said that if the principal is irredeemable, and I pinpointed that irredeemable instrument in this particular case is going to indicate that this is supposed to be an equity component, and a mandatory return would indicate that it's a financial liability component. So put together, you can say it becomes a compound financial instrument. Now, I'm just going to make some amendments at this particular stage. There is a very interesting illustration also, which is given in the study material. And I think before I take you to the study material, I'm now again going to do a little financial management with you, introduce a little concept of time value of money. Now, let me first explain something to you that even yesterday I said that if you've got a compound financial instruments, the proceeds of these instruments has to be split in terms of the equity and the financial liability element. I think I'm not just going to give you a little flair of how this split is done, though we could do a separate discussion on what we call a split accounting. But I'm just giving you a very basic idea that how the split accounting is done for compound financial instruments. The proceeds of that instrument is split in terms of a financial liability and equity element. So I'm definitely considering that you have all the basics on time value money. So I don't need to teach you the concept of time value of money. You can apply your concepts, what you've learned at the intermediate stage, and give me some inputs now at this stage. Let's consider a company issued an instrument where they said that the face value of this instrument is 1,000. So let's say the company issued an instrument which has got a face value which is 1,000. And the company said that, okay, as far as the rate of interest is concerned, we're going to pay you a rate of interest which is, let's say, at the rate of 10%. So they said that we're going to pay you a 10% interest. So the company issued an instrument with a face value 1,000. And they said we're going to give you a 10% rate of interest. And incidentally, this rate is also equal to the market rate. So we can say that this interest rate, which the company has fixed, is supposed to be the contracted rate. So they entered into a contract to pay a 10% rate of interest. And let's say the market rate of interest on these instruments is also, let's say, 10%. The company also said that it's an irredeemable instrument. That means it is supposed to be a perpetual instrument. Now the question rises that what is this instrument? Is it they are paying a mandatory interest and they are paying, the principal is supposed to be perpetual in nature. Now, with the understanding what we got yesterday, we would say it's a compound financial instrument. Because we say that as far as the principal element is concerned, it is equity. And as far as the interest component is concerned, it is FL, making it a compound financial instrument. But now watch me carefully on what I'm about to do. When you calculate a financial liability element of a compound financial instrument, the financial liability element is supposed to be the present value of the future payments. We're going to consider the present value of all the future payments in this case. Now, I have a small little question. In my example, the company is going to pay a 10% rate of interest on the face value of 1,000. So they're going to pay that 100 rupees, can I say forever? Because it's a perpetual irredeemable debt. So the company is liable to pay this 100 rupees of interest till perpetuity. So we can say that this is like a payment of annuity. Because if you've got a common amount which you're going to pay every year by year, so you can say it's an annuity. So this is an annuity which you're going to pay over a period of time. Now, if you remember the concept of time value of money, when you calculate the present value of future payments of an annuity, so we can say this annuity will be divided by the rate of interest. In order to calculate the present value of annuity, which is going to be paid till perpetuity, so we use the concept of A by R. Now, in this case, the annuity payment is supposed to be 100 rupee. That is the 10% interest on a face value 1,000. And the rate of interest to be taken is 10%, which is the market rate. The discounting is not taking place at the contracted rate. The discounting is taking place at a market rate of interest. And when you calculate the present value of this annuity, it comes to 1,000 itself. Wow. So what I'm supposed to do in a split accounting is that if the proceeds were 1,000, you reduce from the proceeds the financial liability and the balancing figure becomes equity. And in this case, the balancing figure is 0. So once again, can you put down what are you up to? I'll tell you what am I up to. I'm just giving you a basic flair of how the split accounting for a compound financial instrument is done. Though we'll learn this in a detail later, but just to give you a little inputs, when a company issues a compound financial instruments, then they raise a certain amount of money. The money which you raise is called the proceeds. So let's say this instrument was issued by the company at a par value. So the face value and the proceeds are equal. So the company in this case raised the money equal to 1,000 itself. Now we need to split this between a financial liability and an equity component. Now, in order to segregate the financial liability and equity, the financial liability is nothing but it is the present value of all the future payments, and you get the financial liability element. The proceeds minus the financial liability, the balancing figure is taken as the equity component of the instrument. So all you need to do is you need to calculate the liability element, and the balancing figure is taken as an equity component. So considering the example that the contracted rate and the market rate is supposed to be the same. So I know that on an instrument which is irredeemable, the market rate is 10% and I am making a 10% payment itself. So when you calculate the financial liability, you would say that on 1,000, we are making a contracted rate of 10%. So this 100 is like the annuity, because this is the amount which you're going to pay forever. So 100 rupees which you're going to pay forever is going to be, you want to calculate a present value of that. So we apply the formula A by R. When you calculate a present value of annuity till perpetuity, using by financial management concepts, we consider the concept of A by R. So we divided this annuity, which is 100 rupees, an absolute figure, by the rate of interest, which is the market rate of interest, 10%, you get the same value. Now, since the proceeds and the financial liability is same, naturally the equity element becomes 0. Now, if the equity element becomes 0, then this is not supposed to be a compound financial instruments. Because if it would have been a compound financial instruments, I would have got some figure as equity. And why did this happen? Why did this happen that the proceeds and the financial liability element worked out to the same? The reason is fairly simple. The contracted rate and the market rate of interest is supposed to be same. So you mean to say that if there was a difference in the contracted rate and the market rate, things would have been different? Yes. Let's assume for a moment that let's say the contracted rate is, let's say 8%, and let's say the market rate is, let's say 10%. So let's consider for the time being that the contracted rate is 8% and the market rate is 10%. Let's see. Can I say in that case, the proceeds of this particular instrument is 1,000. And let's do the split accounting, segregating the financial liability and the equity component. So in this particular case, if I say that the annuity is going to be 8% on 1,000, so the annuity is supposed to be 80 rupees, and this will be discounted at the market rate of interest, which is 10%. And when you calculate the present value of this annuity, it works out at 800. So you're going to get a balancing figure 200, which is supposed to be the equity component. Now, since the contracted rate was less than the market rate, we are getting an equity component. So, but we didn't really understand what are you up to. What is the point which you want to make in this particular case? Now, I think, let me tell you that. So let me now say something. Hear me very carefully and vouch me very carefully on this. Okay, so let me, I think, put it like this. Can I see if there is a contractual obligation to pay cash? I said, don't conclude it's a financial liability. Hear me very carefully, friends, very carefully. Each and every word is going to be very important at this end in order to make the amendment. So I said that if your contractual obligation, that means the mode of payment is cash, please don't conclude it's a financial liability. You need to go to the second stage and see that the payment has to be mandatory in nature. Now I'm saying that even if it is mandatory in nature, please don't conclude it's a financial liability. You should also consider the contracted rate versus the market rate, because the company should be making a payment which does not suppress your obligations. I hope I'm making sense. The company says that I am supposed to make this payment on a mandatory basis, but you should ensure that the contracted rate and the market rate is same. It doesn't lead to any suppression of your obligations. If the contracted rate and market rate is same, it is undoubtedly a financial liability. But if the contracted rate is less than the market rate, it leads to a suppression of liability. The market rate is supposed to be 10%, and we are saying that the contracted rate is 8%. There is a suppression of 2%, and this suppression will give rise to an equity component. So there is definitely a financial liability, but due to the fact that you're paying 2% less compared to the market, this becomes a compound financial instrument. Sir, so the point is that you're saying that if the mode of payment is cash, at the first instance you said FL, you amended. You said if the mode of payment is cash, don't take a decision. Okay. Then we said, let's look at the unavoidable obligation. Is the payment unavoidable? You said if it is mandatory, it is FL. Yes. But now I'm also telling you that you need to look at another input. Even if the mode of payment is cash, even though it is unavoidable obligation, we should also look into the contracted rate and the market rate. If the contracted rate is less than the market rate, it would lead to an equity component. Because I am making a payment at the rate of 8%, whereas the rate at which the liability element will be computed is the market rate. So when you calculate the present value of the payments, you're going to consider the market rate to calculate the present value. So if the contracted rate is different and the market rate is different, this will lead to suppression of liability. And this suppression of liability will lead to an equity component in the instrument, because the proceeds will never match with the amount of financial liability, giving rise to a balancing figure. So if you go back and see, what I've done in this example is that I took the first example where I said the contracted rate is 10%, the market rate is 10%, there was no suppression of liability, giving rise to a pure financial liability. Then I took the second example and I said the contracted rate is 8 and the market rate is 10. There is a 2% suppression in liability. So the amount of contracted rate which you're making a payment, that is annuity of 80, gets discounted at 10%, giving rise to an equity element. Then it becomes a compound financial instrument. So moral of the story, amendment to the chart number 1. So, but this would be an amendment to the step number 2 as well. Technically, yes. Technically, yes. Let me also remind you, yesterday when we were doing 1 or 2 questions, you would remember that there was an input given in the question which said that the rate of interest is commensurate to the credit risk profile of the issuer. And I never said anything on that. I said, let's not talk about this at the moment. But I think now you can make a vouch that if in the question I say that the rate of interest is commensurate to the credit risk profile of the issuer, is he indirectly trying to tell me that the contracted rate is equal to the market rate? Yes. Resulting in the fact that there has been no suppression in terms of liability. So the moral of the story, that if it is an irredeemable instrument, don't worry on that. Especially if it is irredeemable instrument and the payment is mandatory, you should start looking into, is the contracted rate and the market rate same? Then it's a financial liability. But if the contracted rate is less than the market rate, then it's going to be a compound financial instrument. So this is typical. You need to check, especially if it is an irredeemable instrument and the return is mandatory. You don't need to check this if the returns are discretionary. You don't need to compare the contracted and the market rate if it is discretionary. The moment it is mandatory, irredeemable instrument, compare the contracted and the market rate. If the contracted and the market rate is equal, undoubtedly it'll be a financial liability, because what you pay 10% and what you discount is at 10%. So if you're paying the same rate at which a discounting is taking place, it will be a financial liability. But if the contracted rate is less and the market rate is more, then it turns out to be a compound financial instrument. I hope I made sense on that. So let me do one thing. Let me just share the screen back again. I think this time I want to take you back on the study material. So let me just take you back on the study material, friends. I am now going back to my unit number 1. I'm going back to my unit number 1 on page 12.12 and see what I'm discussing is given out here. So it says in the illustration 3, unit number 1 of 12.18, read the facts very carefully. A Limited issues a bond at a principal amount of CU. CU is called a currency unit. It says A issues a bond at a principal amount of currency unit 1,000 rupees a bond. The terms of the bond requires annual payments in perpetuity. So it's an irredeemable bond at a stated rate of 8% applied to the principal amount of 1,000. So the company is liable to pay 8% interest on 1,000, which is going to be 80 rupees paid till perpetuity. Now see what it says, assuming 8% is the market rate of interest for the instrument when it was issued, the issuer assumes a contractual obligation to make a stream of future interest payments with a fair value 1,000 on initial recognition. How do you get that present value? The fair value, can I say the annuity is 80, and if you calculate the present value of annuity till perpetuity, 80 divided by 8% is going to give me 1,000. So the proceeds of the instrument is 1,000 and the fair value of the liability is also 1,000, giving rise to no balancing figure. And if it doesn't give rise to a balancing figure, it becomes a financial liability. It becomes a financial liability. But if in the same question, let's say the market rate of interest was 10%, then in this particular case, it would have given rise to a compound financial instrument. So we can see the answer that the financial asset is an asset where there is a contractual right to receive cash. For the holder, there is a right to receive cash It is a financial asset. For the issuer, there is a contractual obligation to pay cash. It is classified as a financial liability. So you can see in this particular illustration, the concept is very clear that the stated rate of interest, which is the contracted rate, and the market rate of interest, which is again 8%, is same. If the rate of interest contracted and the market rate of interest is same, it indicates that it is undoubtedly a financial liability. It's only if the contracted rate is less, then it is considered as compound financial instrument. I hope I am pretty clear on this. I hope I'm pretty clear on this. So let me just, I think, take this back to you. So I'm not amending, I'm not making any amendments to my, three-step model, but I've just given you a little clarity which is pertaining to irredeemable debt. So what are you going to do in a question now? So the amendment in terms of the chart number 1 stands something like this. So I would say you can make a note of this amendment, which I'm doing to the chart number 1. So yesterday when I gave you the chart number 1, in chart number 1, the only combination which I'm looking at, that it is irredeemable instrument, and I said that the return is mandatory. So we are making an amendment now to this particular combination, that once you face this kind of a combination, that it is irredeemable and it's mandatory, don't jump to the conclusion it's a compound financial instrument. Before that, you should see, is the contracted rate and the market rate same? Yes, it is a financial liability. The contracted rate is less than the market rate? Yes, then it is a compound financial instruments for the reason which I've already given you. Wow, so much to learn in terms of financial instruments. Wow, that's brilliant indeed. Okay, so I think what I promised yesterday, I have fulfilled that promise as well. So one of the amendments to the chart number 1 done. So now we are done with the non-derivative contracts, 3 charts. We're done with derivative contracts, the chart number 4. Now it's time to work upon hybrid contracts with you. Now my discussion is going to sound a little more technical, friends, at this stage. My discussion is going to sound a little more technical at this stage. So even more technical as compared to what we did in the morning. Yes. So I hope you're ready to do some technical discussions with you. You'll understand this very clear. I promise you for that. You'll understand it very clear, but you need to put in all your efforts in terms of listening to what I'm saying. Now with this understanding, I am taking you to my inputs on chart number 5. I'm now going to work on the chart number 5, which is instruments, which is non-derivative, and there is a derivative. So I'm trying to work on my chart number 5. Now hear me very carefully in order to elaborate the concept of my chart number 5, which is on a non-derivative and a derivative instrument. I am first going to take a base to illustrate this to you. I am not talking of optionally convert is on optionally convertible debenture. My focus is on optionally convertible debenture. My focus is on optionally convertible preference share. Now, remember one thing. If you introduce an option, that option becomes a derivative. Oh. So the moment there is an option in a particular contract, the option to convert will mean that it gives rise to a derivative element, a derivative component in the instrument. Remember, we were talking in the early morning in terms of an option contract. The option contract would mean that you may or you may not exercise the option. So that option will be exercised or not depends upon the value of the equity share. If, for example, if a company would issue an optionally convertible instrument, the holder of the instrument gets a right to decide, okay, I want to convert in shares, I want to get a cash. So what will he do to take a decision? Whether he exercises the option or not is dependent upon the value of the shares. and this option is going to be settled in the future, and there is no initial investment done for the option, right? So we can say that that particular option would have the three characteristics of a derivative. But I'm not saying that the entire instrument is a derivative. The presence of an option to convert is supposed to be a derivative embedded in the instrument. Mind the words carefully. So we can say the option to convert within the instrument is a derivative embedded in the instrument. So we would say that this contract is a blend of a non-derivative and a blend of a derivative. So there is a derivative which is embedded inside the instrument. So this is what we technically said earlier is called a hybrid contract. So the question now arises that how do we tackle this optionally convertible instrument in nature? Okay. Now, another thing before I take it further. So one thing I've elaborated that optionally convertible instrument is not a pure derivative. It's not a pure non-derivative. It's a hybrid contract because the presence of the option is a derivative. The entire contract is not a derivative. So there is a non-derivative component and there is a derivative component in the instrument, and this option is resulting in a derivative called a hybrid contract in nature. That's one. Second, generally, I'm saying generally, mind the words generally, what will happen? Let's say, for example, if a company issues an instrument, let's say if a company issues an instrument which is mandatorily convertible. Let's say a company issues an instrument which is mandatorily convertible and it says, okay, I'll pay you a 10% coupon rate. Interest rate is called a coupon rate. So the issuer company says that I'm issuing a mandatorily convertible instrument. Or let's say there is no conversion. Let's not take mandatory. The company says that there is no conversion. The company says that there will be no conversion in the instrument, and it says, I give you a 10% coupon rate if there is no conversion. So do you think that if you give an option to convert, would you pay the same coupon rate? Generally, no. I'm not denying that the company may not pay a 10% coupon rate, but generally, you cannot get your bread buttered on both the sides and eat it too. That's what the saying is. So if a company tells a holder that this is an instrument without any conversion option to you, we give you a 10% coupon rate. So it is but natural that if you give an option to convert, generally you would give less than 10%. Generally, you would give less than 10%. This would indicate that there is a suppression of a liability. This will indicate that there is a suppression of a liability. So if a company issues an instrument where there is an option to convert, we will generally presume, unless mentioned otherwise, that the rate of interest on a non-convertible instrument is 10, then on a convertible instrument, definitely less. And this would indicate the suppression of a liability, indicating that there is an equity element, indicating it's a compound financial instrument. So this is getting very technical indeed. I understand. Let me put this once again to you. Now, chart number 5 is the most technical bit in terms of Index 32. So I'm working on two factors with you. Number one, remember the two golden rules as we discussed the chart number 5, that if a company issues an instrument where there is an option to convert, the presence of the option to convert means that there is a derivative embedded in the instrument. So if you remove that option, it's a non-derivative contract. If you remove the option, it's a non-derivative contract. But due to the presence of that option, it means it's a hybrid contract, where there is a derivative embedded and there is a non-derivative component as well. It becomes a hybrid contract 1. Secondly, I gave you the inputs that when you give an option to convert, and if you look at a comparative position, if you tell the holder that there is no conversion, if you tell the holder that there is no conversion option, naturally you would pay, let's say, a 10% coupon rate. Now, if you tell the holder that I'm giving you option to convert, by giving him the option to convert, you will definitely sacrifice something on his part. You would tell him that I'm not going to pay you the same coupon rate which I pay on a non-convertible instruments. So generally, you'll end up paying a less than 10% coupon rate. This suppression of an interest rate below 10% would give rise to equity element, as we just saw in the discussion above. So the moment it gives rise to an equity element, I could safely assume that it's a compound financial instrument. So, sir, are you indirectly trying to say that if I am given an optionally convertible instrument, I could safely assume that if the interest rate on a non-convertible instrument is 10% and on a convertible instrument is less than 10, undoubtedly compound financial instrument? Yes, sir. So can I also conveniently say the presence of the option is indicating a presence of a derivative embedded in the instrument? Yes, sir. So which means that the moment you see a question in the exam where there is an option to convert indicates hybrid. And the moment you read the question and it says that the contracted rate on a non-convertible instrument is 10%, for a convertible instrument below 10% indicates it's compound financial instrument in nature. Right? I guess I am well understood so far. Okay, now let's take the journey forward. Having understood that this hybrid instrument is a compound financial instruments and there is a derivative embedded, now what I'm going to do, watch this carefully. Now what I'm going to do, I'm going to first of all see that the option to convert is with whom. I will see the option to convert is with whom. Is the issuer kept the option himself? Has the issuer kept the option himself, or is it the option given to the holder? So the first thing which you're going to do is you're going to look at who's got the option to convert. Is the option to convert with the issuer, or is the option to convert with the holder? Now, if you say the option to convert is with the issuer, please hear this very carefully. If the issuer has got the option to convert, he has got a contractual right, friends. If he's got the option to convert, he's got a contractual right. A contractual right will indicate that there is a financial asset. The option is a financial asset. So what I will do in this case, there is a non-derivative portion and there is a derivative portion. The instrument has got two portions. One is the non-derivative element and one is the derivative element. The derivative element is nothing but it is a financial asset for the issuer. Because by getting the option to convert with the issuer, he's got a contractual right that gives it a financial asset. And being a compound financial instrument, the non-derivative will be segregated in terms of the financial liability and the equity. So you're going to get a total of 3 components in that instrument. You're going to get a total of 3 components in that instrument. There will be a financial liability, there will be an equity component, and there will be a financial asset as well. So can you take an example and tell us how these 3 components will be segregated? Okay. Let's say the proceeds of this instrument. Let's say the proceeds of this instrument is, let's say, 1,000. Now, how would I get the value of this derivative? Well, the value of this derivative will be done by the valuer. They would use, what you call in financial management as the Black-Scholes model. So the company, the valuer, would actually use a Black-Scholes model and will give you a certification that this is the value of the derivative. So let's say he did the derivative valuation, and the derivative valuation, let's say, comes to, to the extent of 120. He does the derivative valuation. He says that the derivative is worth 120. Now, what is the value? I'll calculate the financial liability. I'll calculate the financial liability by taking the present value of future payments. And let's say the present value of future payments comes to, to the extent of 800. Let's say the financial liability, the present value of the future payments comes to 800. Then what I will do, I will take this equity as a balancing figure. Now, many people, what they will do when they take a balancing figure, they will say proceeds are 1,000 minus 800 That is the figure which is supposed to be the financial liability minus 120, and they will say 80 is the balancing figure. No, friends, no. 80 is not the balancing figure. The financial liability relates to the liability side of the balance sheet. The equity relates to the liability side of the balance sheet. And the financial asset component relates to the asset side of the balance sheet. So you need to ensure that the sum total of FL plus equity minus FA is 1000. Are you getting the point? You need to ensure that the sum total of this 800 plus the equity minus the asset is supposed to be equal to 1000. So accordingly, you will get a balancing figure in this case. So I would work it out that if I now take the balancing figure, it is supposed to be 320. Because now if you make a cross check, I would say it's 800 plus 320 minus 120, that makes 1000. So the moral of the story goes like this, that if it is an option to convert, you need to first of all see who has got the option to convert. Is the conversion option with the issuer? If the conversion option is with the issuer, remember, it's a contractual right. If it is a contractual right, it will lead to that the derivative is supposed to be a financial asset. The derivative is the financial asset because it gives you a right. So we'll have three components of this instrument. One is being a non-derivative compound financial instruments. You split the financial liability in equity components, and the derivative is split in terms of FA. And I took a very simple example to illustrate. The derivative value will be given by the valuer. So even if it comes in the exams, you will be given the value of the derivative, and you will take the value of the financial liability as the present value of your future payments. So you take the value of the financial liability, you given the value of the derivative by the valuer, and you take equity as a balancing figure. But when you take equity as a balancing figure, remember that you need to take the sum total of financial liability plus equity minus the financial asset. Add the FL equity and minus the FA, that will equal to the proceeds. That's how you will get the value of equity element. I hope I'm clear. I know what I'm saying is pretty technical indeed, but I hope I am clear. Okay, now let's take the journey forward. Now we're coming to the second agenda where the option to convert is with the holder. Now we are saying that the option to convert is with the holder. If the option to convert is with the holder, then it is a right of the holder and not of the issuer. Then in this particular case, we need to now apply, since this option is a derivative which is going to be settled in equity shares, you now need to apply a fix for a fixed test. So in this particular case, the non-derivative will be segregated in terms of being a compound financial instruments, FL and equity, undoubtedly, because if it is a compound financial instrument, we will definitely segregate the FL and the equity element. Now for the derivative, you need to apply the fixed for a fixed test. That's what we've seen, that if the option will be settled in terms of equity share, the mode of payment is equity shares, then you apply the fixed for fixed test. Now, when you apply the fixed for fixed test, either it passes, the consideration and the number is fixed, or it fails. If it passes, that means this derivative is equity. This derivative is equity component, and if it fails, then this derivative is financial liability. Now, one thing which I'm going to tell you at this stage, for which the logic will become clear later in 109, the standard says that if the derivative is passing the fixed for fixed test, there is no need to segregate the derivative. If the derivative has got equity characteristics, then there is no need to segregate the derivative, which means that I will not segregate the derivative component in this instrument if it meets the fixed for fixed test. But if you say that it fails that particular test, then you need to segregate the derivative. Now, why there is no need, that logic will come later when we come to Index 109. I know what's going in the back of your mind. You must be thinking, sir, can you please consolidate this entire inputs once? This is getting heavy, right? Let's make a run through. Before we give you a chart number 5 final version, let's make a run through in terms of the chart number 5. So we are now looking at the concept of a hybrid instrument. So let me remind you that we are now looking at a concept of a hybrid instrument. When I say an hybrid instrument, you can generally say a hybrid instrument would be generally an optionally convertible instrument. When a company would issue an instrument where there is an option to convert, so if the option to convert is not there, it's a non-derivative contract. But when you insert the option to convert, it embeds a derivative in the contract. So the best example for a hybrid contract will be optionally convertible debenture, optionally convertible preference share, 1. Second, we need to understand that if it is an optionally convertible instrument, one thing is pretty clear, that on journal levels, we can say that if a company issues an instrument without an option to convert, and they're willing to pay a 10% coupon rate, then if there is an option to convert, they will never issue an instrument at 10%. Generally, they would land up paying less than 10%. And I think based on our discussions earlier, I very clearly said that if there is a payment of interest less than the market rates, because you know that you're paying a 10% coupon without conversion, so you're paying less than 10% if there is a conversion option. So this will lead to suppression of a liability, and it would lead to a compound financial instrument. So optionally convertible would be a best example for hybrid, and optionally convertible would lead to the fact that it is a compound financial instrument. So two things what you need to keep in mind. The option to convert will lead to a derivative embedded, and the option to convert would mean that it's generally a compound financial instrument. Now, going with the fact that if it is a compound financial instruments, we can one thing clearly say, and that is that as far as the non-derivative portions is concerned, you're going to segregate the non-derivative portions in terms of, you can say FL as well as equity. But now we're just working on that derivative element. We're just working on that embedded derivative element. And for this purpose, you need to see who's got the option to convert. Is the option to convert with the issuer? That indicates a contractual right of the issuer. And if it is a contractual right of the issuer, this derivative will become a financial asset. And if you say that the right to convert is with the holder, then you need to apply the fix for a fixed test to decide that is it supposed to be equity or is it supposed to be a financial liability. If you fail this test, it becomes a derivative financial liability to be segregated. If you pass the fix for fixed test, then it is equity, and the standard says don't segregate the derivative embedded in the instrument. Right, I guess I made sense on that. I know it's a pretty heavy discussion indeed, but let me just get your inputs. I hope I'm pretty clear on this. Okay, I think Shubham tells me clear, session's really nice, getting confidence, wonderful indeed. Okay, you got a question, but for the holder, it is a financial assets all times. No. You know, you would now see that I made a little amendments to this part as well. You know, I'll show you something very interesting. If you read the text of the standard, this is just for your purposes, you will see that, you know, whenever we say that the issuer issues an instrument, what comes is that it's FL. What comes is it's equity. What comes in the mind is it's FL and equity both. I think this is for the first time today. We're looking at the instrument of the issuer includes a financial asset component. The moment the right to convert, the right option to convert is with the issuer, the instrument is containing a financial asset. So this is something very interesting, because generally what comes to the mind of the people is that the instrument is either got a liability or equity or a blend of liability equity, but there can be an instrument which also includes an FA component. So when it is FA for the issuer, then that component will become technically an FL for the holder, right? But we're not talking of the holder right now. Index 32 is concentrating in terms of only, you can say, the issuer perspective. How does he classify the instrument, right? I guess, Shubham, you got your answer on that. Okay, Aniket said a little confused now. I think let me just do a consolidation now. So let me just do this consolidation, get the chart number 5. You'll get comfortable on this. So I think first thing, let me put some notes to you. I'm now working on my chart number 5. Please note it down. And I think after make a run through, you'll definitely get inputs. This is a highly technical area. This is a highly technical area, so don't get worried if it is shaking you. I think it's perfectly okay. It is shaken you, it's perfectly okay, because this is very, very technical indeed, but it's a beautiful concept to understand. Now, so in chart number 5, I'm looking at hybrid contracts. In chart number 5, I'm looking at hybrid contracts. After this, we're going to do a little consolidation with you in terms of what you've learned so far, so that you get the things. But do please revise these 2 classes. You'll get a very good hand, trust me. So when I say hybrid contract, it is non-derivative plus derivative combined. Now, one thing which I said, if you see in a question that there is an optionally convertible instrument issued, let me make 2 statements and you vouch me. Can I comfortably say that if you see an optionally convertible instrument in the exam, can I conveniently say that it's a compound financial instrument? And can I also conveniently say that the option means the presence of a derivative? Vouch me a yes or no. So the moment you see it's optionally convertible, why did I say it's a compound financial instrument? Because the rate of interest on a non-convertible instrument is going to be greater as compared to the rate of interest on a convertible instrument. I hope I'm making clear-cut sense. It might create a little pressure on your mind, but I think you're getting the fact that why I'm calling it as a compound financial instrument, because the rate of interest on a non-convertible instrument will be greater as compared to a convertible instrument, right? I guess you are able to get this, Aniket. Wonderful. And in this particular case, the option creates a derivative. This is one thing which I've embedded in your minds. Okay, so this is optionally convertible conclusion. Now, in order to decide that this instrument will be split into how many components, what we need to do in this particular case, you need to put across the $1 million question to you. And what is that $1 million question? The $1 million question which you need to put across is, who has the option to convert? Who has the option to convert? So we need to understand that who has got the option to convert. So we are looking at the option. We're looking at the option. I'm looking at the derivative element of the contract. I'm not looking at the non-derivative element. So I said, okay, who's got the option to convert? I said the option to convert is either with the issuer, or I said the option to convert is with the holder. So when you're going to look at the question will clearly give you the status that who has got the option to convert. If the option to convert is with the issuer, remember there is a non-derivative element and there is a derivative element. Even if the option to convert is with the holder, there is a non-derivative element and there is a derivative element. Now let me ask you another question. Can I say on the non-derivative portion, it's a CFI. So do you split the FL and the equity, whether the option is with the issuer, whether the option is with the holder? What do you say? So when I'm looking at the non-derivative portion of the contract, it is a compound financial instruments for sure. And if it is a compound financial instruments, very rightly said, we will definitely segregate the FL and the equity element. The FL and the equity element will be segregated. Now the only question comes, think logically and answer. If the option to convert is with the issuer, he has got the right to convert, not the obligation to convert. If he's got the right to convert, it means it is a financial asset. Correct. And if you look at from the point of view that the holder has got the right to convert, then it's an obligation for the issuer. Because if the holder has got a right, it's an obligation for the issuer. You need to apply the fix for a fixed test. You need to apply the fix for a fixed test. And if this test passes, then you can say this derivative is supposed to be equity element, which the standard setter says don't segregate. Why? Still pending. Still pending. I'm not giving you the logic. And if this fix for fixed test fails, then this is a financial liability. And if it is a financial liability, segregate. Which means effectively, I can definitely say that if you are looking at the option with the issuer, you need to segregate three components of the instrument. If it is a holder option, then it depends. You might be segregating just two, or you might be segregating three components. If the derivative passes the fix for fixed test, you'll only segregate the two components of the non-derivative. If it fails the fix for fixed test, you'll be segregating the three components of the instrument, the two non-derivative elements, and the derivative financial liability as well. Right, I guess I made myself pretty clear. I guess pretty clear. I think, Aniket, the confusion is gone. I guess everybody is able to get the concept very clear. I know it is technical, but I think technical things can be very interesting at the same time, right? Right. So I guess I am pretty clear with my concept, I guess. Okay. So as promised yesterday, I've been able to create all the 5 charts to you. And I think now I want to definitely, take you to a little mind mapping as I generally do. So let me do a little mind mapping at this particular stage, because I think this is the right time to give you mind mapping. Yes, very clear, Aniket. Wonderful indeed. Okay. So now let's do a little mind mapping with you. We're not done with Index 32 completely. There is more to go on Index 32. Typically, we need to discuss now the accounting of compound financial instruments, which of course we'll do in the coming session with you, not today. So now we're just going to create a little mind mapping with you. So I think when I am creating a mind map, what is coming to my mind is that now I've got a final 3-step model with me. I've got a 3-step model with me, and this 3-step model, I'm not repeating it. I think you've already know the final details, but I think I just want to put some connections to you. Then when you apply the 3-step model in terms of step number 1, your mind starts working on 2 important inputs, that the obligation needs to be contractual. That's one focus point. The second focus point, what comes to the mind, is that obligation has got 2 components. One is the principal and one is the return. It only throws a little light on the fact that I need to make a run through of my 3-step model for the principal component separately, for the return component separately. Then you come to the step number 2, and the focus point is the mode of payment. And especially when the mode of payment is cash, now you've learned something, and you've learned two new things now. One is you need to see that it is unavoidable in nature before you call it as a financial liability. And the second thing, typically in terms of irredeemable instruments, that you need to see that the contracted rate should be equal to market rate before we call it as a financial liability. So I think this is one caution which I've given you, that if the mode of payment is cash, and we need to see that it's mandatory, and at the same time, if it is irredeemable instrument, just be a little careful on that the contract rate and market rate is same. If you are able to prove both the factors, then it becomes a financial liability to that extent. If you're able to prove both the factors, then it definitely becomes a financial liability. But if you're not able to prove the factor that it's unavoidable, or you're able to say that the contracted is less, it could become an equity or a compound financial instruments as well. Then we said the mode of payment is equity shares. Then you go to the step number 3. And our focus is very clear on the step number 3, that you need to decide the nature of the contract. So when you're deciding the nature of the contract, your derivative has got a total of 3 characteristics. I'm not putting those 3 characteristics, but your mind should be very clear that we need to prove that the value of the of the instrument is dependent upon an underlying asset, you need to see that the initial investment is zero or negligible, and there is going to be a future settlement. So depending that it's a derivative or a non-derivative, you accordingly conclude what kind of test do we need to apply. If it is a non-derivative, you know that we apply the fixed test, and if it is a derivative, you need to apply a fixed for a fixed test, and you know the conclusions. That you need to see a number for a non-derivative, and you need to see the number and the consideration for the derivative. This is the three-step model, and based on a three-step model, what I did with you, I created a total of 5 charts with you. And I think now if I look at the blend of the charts, I gave you a total of 3 plus 1 plus 1. I gave you 3 charts. This was purely concentrated on a non-derivative element. Then I gave you 1 chart which was purely concentrated on a derivative instrument. And then I gave you the 5th chart. There is 1 chart which was a blend of a non-derivative and a derivative. In this non-derivative 3 charts, I gave you 1 chart where the mode of payment was completely cash. So we were looking in terms of the unavoidable. And now we've also inserted the contract rate and market rate. The other chart where the mode of payment was equity, and the other chart where the mode of payment was equity as well as cash. Then we took the derivative chart, and in the derivative chart, the focus was that we are doing equity settlement. We applied the fixed for a fixed test. Here we applied the fixed test. And then I gave you a derivative and a non-derivative, and wherein I've already given you the blend that in this case, we need to see who has got the option to convert. That is the deciding factor. So whosoever gets the option to convert, that becomes a deciding factor. This is all what we have learned so far on this particular standard. Now, I think it's time to test you on certain MCQ questions, friends. So far, so good. So I would definitely say, okay, now Shobham, you've got a question. So, but when there is a right with the issuer, then isn't that a value embedded in the FL inequity component? Yes. So what's the need to show it as an FA? The financial asset will be reflected on the asset side of the balance sheet for the issuer. And the equity and the FL component will be reflected on the liability side of the issuer. So he would represent 2 components on the liability side of the balance sheet and 1 component on the asset side of the balance sheet. So from the presentation perspective, considering the 2 elements relates to liability, 1 element relates to the asset side, I think the segregation is important. Now the question remains, why are we taking so much of a trouble to segregate that derivative? Which you'll understand when we come to the accounting treatment, that why does a derivative need to be segregated? I'll be able to illustrate this better when I come to the specific discussion in Indus 109 relating to the discussion on embedded derivative accounting. So that's going to take a little time, I guess. So you'll get the very clear-cut answer why there is a need to segregate a derivative, right? So don't get worried, that will definitely get answered later. Okay, now I think it's time to give you some MCQ questions, friends. And I think let's give you some questions. I'm not going to share the answers today. I'm just going to give you the questions. We'll discuss them in the next class with you. My question number 1. If mode of payment is cash, we are not concerned whether it is derivative or non-derivative. I said the question clear, that if a mode of payment is cash, we are not concerned whether it is derivative or non-derivative. Number 2, if mode of payment is equity shares, we are concerned whether it is derivative or non-derivative. So here the focus is that if the mode of payment is equity share, then I am concerned it's derivative or non-derivative. Number 3, if mode of payment is equity shares, we apply fixed test only. So the mode of payment is equity shares, we apply fixed test only. Number 4, if all 3 characteristics are met, if all 3 characteristics are met, if all 3 characteristics of a derivative are met, if all 3 characteristics of a derivative are met, only then it can be called, derivative. So I've said if all 3 characteristics of a derivative are met, only then it can be called as a derivative. Number 5, fixed for fixed test applies to non-derivative contracts. Fixed for fixed test applies to non-derivative contracts. Okay, I think that gives us a blend of all the testing in terms of, I think, what we learned today. I'm not giving you the answers on this. I think I've just given you the focus in terms of the 5 questions. And I think if you've understood our inputs today, I'm pretty sure you'll be able to answer all these questions. I'll be answering these questions in the next session with you. No worries on that. I'll definitely get back to you on these particular agendas. Right, friends. So I think that's been quite good learning. So my sincere request now again would be that please do take your time and do revise these classes. I think you've got access to these classes through the YouTube channel as well and through the app as well. So just take a little time and maybe you can watch these classes and go through them once again at your convenience, at your speed factor as well, 1.5x or whatever. And that'll give you a very consolidated, good revision. We'll continue the trail of discussions with you in the next class with you. I think it's now time to bid you goodbye on that. If you've got any questions, please feel free to ask. And thank you, Aniket. And got it for the true and fair view, right, Shobham? Can you share the notes with us? Well, I would be sharing these MCQ questions. I'll be definitely uploading these MCQ questions to you as well. I'll see if I can share the slides also. I think I'll do that. Maybe I think I have the access. I'll do that, Shobham. I think it's not a problem. We'll do that as well. We'll share it on the dashboard access itself. Nidhi, thank you, sir. Really a great session. Thank you so much, Nidhi. I think it's a pleasure. I hope you're all been able to catch up with the concepts very well, and it's a pleasure to be connected with all of you. Right, I think there seems to be no more questions coming in. Okay, right. So I think it's time to bid you goodbye, friends, on that. So I'm going to close the session now. Thank you, take care, and goodbye.